Hello, my name is Andrew, and today I'll be presenting my valuation of Walt Disney Company using two different approaches. First being a discounted cash flow model and a comparable company analysis. So Disney was trading at $113.47 per share on September 26, 2025. And since Disney is publicly traded, we already know the market price. The real question is whether that this price is justified based on the company's fundamentals. So to answer that question, I valued Disney independently and then compared my results to the market price. My discounted cash flow produced values ranging from about $73 to $105 per share, depending on the terminal value method used. And my comparable company analysis produced a value of roughly $107 per share. And since all of these estimates fall below the market price of $113, my conclusion is that Disney appears modestly overvalued. And importantly, I wanted to say that I did not adjust assumptions to force the model towards the market price. The difference between my value and market value is shown in my calculations. So before building the valuation, it was important to understand the business and the comparables. So Disney generated around 94 billion in revenue in 2025, and through this was through three major segments. First being entertainment, then sports, and lastly experiences, which includes parks, resorts, and their cruise line as well. And for my comparables, my comparable company analysis, I used a peer group that included Comcast, Fox, Netflix, Warner Brothers, and several other entertainment and park operators. And one challenge is that this group is highly dispersed. For example, Netflix trades at a much higher valuation multiple than most peers, which can distort simple averages. And because of that, I paid close attention to which multiples were actually meaningful. Now to go over my forecast, I forecasted 5 years, 2026 through 2030. Revenues grow from roughly 94 billion to 123 billion, which represents about a 5.3% annual growth. I also forecasted EBITDA margin expansion from 21.5% to 24% as Disney continues improving streaming profitability and benefits from growth in its experiences segment. And the other major assumption is that capital spending, which became the focus of my first deep dive. So Disney is currently in the middle of a major investment cycle. Capital expenditures increased from about 5.4 billion in 2024 to 8 billion in 2025, and management has guided towards roughly 9 billion in 2026. So this spending is driven by the new cruise ships and Disney's long-term plan to invest approximately 60 billion in the parks and experiences. So because of this, I felt it would be unrealistic to keep CapEx flat as the percentage of revenue. So instead, I model CapEx at about 9% of revenue initially and gradually declined it to 7.5% by 2030. This results in a lower free cash flow and ultimately a more conservative valuation. So my second deep dive focused on the other long-term liabilities. So previously I held this balance constant, but I wanted to understand what was actually included in this account. So looking into it, much of the balance related to deferred taxes, pensions, leases, and deferred compensation. And after reviewing the disclosures and testing several forecasting approaches as seen there, I selected a modest growth path that increased the balance from roughly 10.6 billion today to about 12 billion by 2030. So the key takeaway is that I tested multiple approaches rather than simply just holding flat like previously. Next, I needed a discount rate. So rather than pulling a beta from a finance website, I estimated the Disney's beta myself using a 16-month regression of Disney's excess returns against market excess returns. The regression produced a beta of 1.43, which was very close to the published estimate from Yahoo, which was 1.42. And then using the CAPM, I calculated a cost of equity about 10.8%. And after combining that with Disney's after-tax cost of debt and capital structure, I arrived at a weighted average cost of capital of 9.5%. Now, looking at the free cash flow, using those assumptions, I projected an unlevered free cash flow for 5 years. Free cash flow grows from about 6.2 billion in 2026 to approximately 14.4 billion in 2030. The lower 2026 value reflects Disney's peak investment period and a one-time working capital adjustment. So after that, free cash flow increases steadily as margins improve and revenue grows. So next is terminal value. So since terminal value represents a majority of the discounted cash flow value, I estimate it in two different ways. First one being using a growing perpetuity approach, which produced a terminal value of around 203 billion. And then second, I applied a 10 times EBITDA exit multiple, which produced a terminal value of around 294 billion. And this exit multiple is intentionally conservative, which is relative to Disney's current trading multiple of 12.7. So this project also asks what perpetual growth rate is implied by the exit multiple method. So by setting the exit multiple value equal to the perpetuity formula and solving for the growth, I found an implied growth of around 4.4%, which is roughly double the 2.2% growth rate supported by my fundamental assumptions. So this tells me that the exit multiple approach is the more optimistic of the two methods. So after discounting the projected cash flows and the terminal values back to present value, my discounted cash flows produced two estimates. The growing perpetuity method resulted in a value of $72.72 per share, and then my exit multiple method resulted in a value of $105.14 per share. So as you can see here, both estimates are below the market price of the $113, which suggests that Disney appears to be overvalued on the DCF basis. So then I valued Disney using the comparable company multiples. Some valuation methods produce very high estimates because companies like Netflix trade at unusual high multiples. The metric I found most reliable was enterprise value to EBITDA because it minimizes the impact of differences in the capital structure. So using that approach, Disney implied a value of approximately $107 per share. That result closely aligns with the DCF exit multiple estimate and is slightly below the market price. So to understand what drives value, I performed a sensitivity analysis. The two variables that are the largest impact on the valuation were EBITDA margin and capital expenditures. Changes in the sales growth, taxes, gross margin, and working capital had much smaller effects. This was reassuring because two of those major drivers were exactly the areas I focused on my deep dives. So to conclude, my discounted cash flow valuation range was approximately $73 to $105 per share, while my comparable company analysis suggested a value of roughly $107 per share. All these estimates fall below Disney's market price of $113 per share, and based on my analysis, Disney appears modestly overvalued, and the market seems to be pricing it stronger long-term growth or more optimistic valuation multiples than my assumptions support. Thank you and have a great day.